Ladies and gentlemen, good day and welcome to the Federal-Mogul Goetze Limited Q4 FY22 Analyst Conference Call. As a reminder, participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. I now hand the conference over to Ms. Mamta Samat from Perfect Relations. Please go ahead, ma'am.
Thank you, Peter. Good evening, everyone, and thank you for joining us on Federal-Mogul Goetze India Limited Q4 FY22 Analyst Conference Call. Today we have with us the senior management represented by Mr. Vinod Kumar Hunt, Managing Director, Mr. Manish Chadda, CFO and Finance Director, and Dr. Khalid Khan, Director, Legal and Company Secretary. Before we begin, I would like to add that some of the statements to be made in today's discussion may be forward-looking in nature. We will begin the call with the opening remarks from the management, after which we will have the forum open for an interactive Q&A session. I will now request Vinod, sir, for the opening remarks. Over to you, sir.
Thank you very much. And
Hello, sir. Can you hear me?
Yeah. I think there was a lot of echo.
You can proceed, sir. Sorry.
Yeah. So welcome again to this analyst investor conference call. Thank you for joining. I think in the beginning I will say that on the overall economy, if you see particularly the way we are segmented, we have been talking this post-COVID recovery pattern, whether it is V-shape or L-shape or whatever. I think more and more direction as we see is, the phenomenon of K-shape recovery, I would say is more, we are heading towards at least the last few quarters. Why I say K-shape in general, whether you see rural versus urban, that's a phenomenon where probably the urban economy have propelled more than the rural one. And when you go to the industry specific sides, so you see that the manufacturing versus non-manufacturing. So non-manufacturing is on the upper side of the K and manufacturing being on the lower side of the K. When we further see how is our business segmented into the automotive part of the manufacturing, again we see a K in automotive as well, where we see very clearly during last year, the passenger vehicle or the commercial vehicle, they recovered very well on the upper side of the K, and the two-wheeler and tractor in particular, they were on the bottom side of the K. Also because these two segments, tractor and two-wheeler, are impacted more by the rural phenomenon as well. So I would say that is one particular aspect in front of us, and we are continuing to monitor this recovery, and we'll continue to talk because there are again some signs of two-wheeler and tractor getting back to the earlier numbers. So there are some signs around this. Second phenomenon again was impacted by the material cost. So material, again, driven by a lot of geopolitical issue as well as some internal issues and also related to some supply chain input materials. We saw volatile environment in the material or commodity prices. It continues actually. While we have a recovery from the customers on one side, we do have additional exposure from the material, and we'll discuss more when we go to the specific presentation and Q&A mode. So again, the quarter was again, I would say overall impacted by the material or commodity movements actually. Second, third portion, I would say again there were two phenomena on the geopolitical side. One was the Ukraine and Russia, impact, where I would say again it did not, I would say, impacted us directly, but indirectly it did impact some of European and other market where we had export some share of those actually. And of course, in this quarter we also had China lockdown, and China lockdown impacted a lot of, I would say, freight-related, constraints. Although we do not have any major dependence on China in sourcing supplies, but nevertheless, it generally creates overall impact on the freight and shipping lines and those kind of things actually. So I would say these were the three broad phenomenon which impacted the quarter. Some I would say silver lining when you see from a previous quarter, the semiconductor availability improved, although the uncertainty still remains. But the semiconductor dependent vehicles, whether passenger vehicle or commercial vehicle, did significantly improve on quarter-to-quarter basis. Although our OEMs, particularly in passenger vehicle, still claim the demand, much ahead of the capacity to supply because of limitation of semiconductors. So overall, I would say very interesting quarter where there was a recovery for sure, a very visible sign from the previous quarters. But still, when we compare this quarter to the last year quarter, which was the best ever quarter probably overall for the automotive industry and automotive component supplier, was a little bit challenged both on the semiconductor as well as some drag on two-wheeler and tractor. So that's how I would say summarize the overall situation we are in, and we'll discuss in specific more as we go into the presentation and Q&A. I would request Dr. Khalid to run through the company presentation.
Thank
over
you.
Over to you, Dr. Khalid.
Thank you, Mr. Amir. So first slide is the safe harbor slide. To be said that the statements contained in this presentation are forward-looking. Next slide is about the overview of the company. So Federal-Mogul was set up in 1954. It was initially a joint venture with Goetze, Turkey of Germany. Then this brand was owned by Federal-Mogul LLC at that point in time. But globally, now it is a subsidiary of Tenneco Inc. And globally, Tenneco has four businesses, mainly performance solutions, motor parts, clean air, and powertrain. Company's products substantially fall under powertrain business group. So we are based out of Gurgaon, and the company is engaged in the manufacture, supply, distribution of automotive components in India as well as internationally. So mainly the company offers pistons, piston rings, piston pins, ball screws, and ball guides. So the company caters to automotive, heavy-duty motorcycles, energy, industrial, power generation, railway, and defense industry. FMGL, the company manufactures world-class products at its state-of-the-art manufacturing facilities, which are located at Patiala in Punjab, Bengaluru in Karnataka, and Bhiwadi in Rajasthan. So in terms of employees, the company employs more than 5,000 people as on 31st March. And then we have 3 manufacturing sites, 2 sales offices, and 13 warehouses. In terms of our customers, we have 30 plus OEM customers. In terms of manufacturing footprints, there are further details. So Patiala plant is spread over 60 acres of land, and basically the products are piston, pins, and piston rings. and this is the oldest plant which was initially established in 1954 when the company was incorporated. Coming to Bangalore plant, it has an area of about 50 acres, and it has the same products, piston pins, and piston rings. And this plant was established in 1977. The third plant is pretty new as compared to the last two plants that I just now discussed. So this plant is located at Bhiwadi, Rajasthan, and the area is around 5.5 acres. And the products are valve seat and valve guides. This plant was established in 1996. All these plants are certified IATF 16949, ISO 14001, ISO 45001. Coming to the shareholding pattern as on 31st March, so we continue to have this similar and same shareholding pattern. So our parent company, which is Federal-Mogul Holdings Limited, is holding 60.05%, and another promoter company, Federal-Mogul Germany, is holding 14.93%. And the minority shareholders are holding 24.98% shares. Coming to the board of directors, there has not been any changes in the board of directors. So board of directors is chaired by an independent director, Mr. K.M. Subramanian, so who has been around for a long time now. So we, out of 9 directors, 3 directors are independent directors, and including 1 women independent director. Then we have 4 executive directors, and we have 2 directors who are non-executive and non-independent. Then for the next slide, and regarding marketing and sales slide, I would request Mr. Vinod to walk you through. Mr. Vinod, over to you.
Yeah, thank you, Dr. Khalid. On slide next slide, on slide 7, on the competitive strength, very much similar what we have been presenting. So we continue to enjoy a good credit rating, long-term A+ and short-term A1+. Our in-house technical centers at Bangalore and Bhiwadi are getting further traction with the seamless technology transfers. So we are getting a benefit of being, I would say, seamlessly integrated into a larger pool of global network of technical network, and that's helping us to consolidate our market position within the domestic market. It is in line with what we have been aiming at, and as we progress further on these regulations coming from the government, we stand to gain a lot from there. We have a well diversified segment. We are supplying to two-wheeler, tractor, commercial vehicle, passenger vehicle, railways, defense, reasonable export. So we have pretty much, I would say, well diversified, and which can handle these fluctuation of the market, which we discussed that although we had somewhat I would say low demands from tractor and two-wheeler during this time, but our ability to push more on the passenger vehicle, commercial vehicle did help us to even out these variations in the market, if I have to say. We continue to remain, in terms of liquidity, we continue to have a strong position. So our customers are pretty happy and confident on our sustainability. That is helping us in securing new businesses, which are, by the way, long-term now. And we have, of course, a highly stable and experienced team at our leadership and middle management level. On the next slide, our customers, and you see, again, without going into detail, and so it's pretty nicely distributed between the 4 or 5 segments which I mentioned. Not to add, but we have a reasonable presence in the industrial segment also, where the likes of the gensets in particularly and industrial engines. We have pretty good, I would say, market share in that. And in terms of plant, Khalid already described, we have 3 major manufacturing plants and supported by technology centers in Bangalore and Bhiwadi. On the next slide, again, a distribution of revenue split by domestic and export. So this remains, flat as compared to the previous year and quarter. When we see the overall revenue, we would have liked to, improve on our export. Nevertheless, the last particular quarter did have some, issue on our export, resulting out of the factor I mentioned on the Ukraine and Russia issue. Although our direct exposure is about 7 to 10 crore for the year, so it's not significant. But then, because of the situation, the European market overall went down actually, and that impacted our supplies to the OEMs which are in mainland Europe. So, but even with that, our I would say ratio of export, still remained at 14%. With respect to giving you an idea of how we are segmented, so our revenue, 28% of our revenue comes from passenger vehicle, about 12% comes from 2 or 3 wheeler. So if you see these 2 segments are seem to be impacted by electrification. Although electrification from our point of view is still some time away, but it's fair to mention that 40% of our business, 28% on passenger vehicle and 12% in 2-wheeler, is impacted by electrification. Nevertheless, we have a good spare market business of nearly 27% coming from our independent aftermarket as well as our spare supplies to the OEM. So that is good 27%, and 33% comes from commercial trucks, commercial vehicle, off-highway, industrial, and other stationary engines, which are far away at the moment from the cloud of electrification. So in summary, I would say our 60% of business is electric agnostic, if I have to use that word, and it's pretty healthy. And we are also trying to see how we can increase this pie of the revenue to navigate better through this kind of situation we have in front of us. In terms of market position, going to the next slide, we have overall number 2 position in piston. We have number 1 in diesel piston. In rings, we are number 1, and wall seat and guide, we are number 1. In terms of the requirement of our product, we presented this slide in the last conference as well. So if you notice, we have added hydrogen and flex fuel. So there are 3 drivers. Let me summarize this slide. There are 3 drivers for the OEMs coming from the end user perspective, that they need a better fuel economy, and then the lower emission regulated by the government, and of course the durability side and the life. We are talking a life of nearly about 300,000 plus for commercial vehicle, and so we are into that kind of life of the vehicle at the moment, and progressing further. So there's a big push on these 3, and our products are nicely placed to answer all these drivers. So we are nicely positioned, and when you see these blue dots, that's really explain how we are nicely positioned for these three drivers. Interestingly, we started working on hydrogen. For the sake of confidentiality, I cannot name, but we are working globally with 10 OEMs. A few of them are also from India, and we are pretty much, I would say, orienting ourselves with respect to our test beds and design and these capability, and we are working very, very closely with the OEMs on the hydrogen. While we work on hydrogen, which will be a little far off at the moment, medium term maybe, but immediately a lot of good, I would say, quick hits on the flex fuel side. You would know that the market is quickly shifting into the CNG side. So there was a 4% point shift made during last year towards the CNG side of the four-wheeler segment. So here also we are nicely positioned, and besides that, we are also working on ethanol-based and biofuels and all. Fortunately, our products are, I would say, positioned nicely, and we do have an experience in a different global market where our formulations or tweaking of the product is already established, and we are putting these proposal in front of customers in near term, so that the adoption could be done very quickly. With that, I will hand over to Manish Chadha, who is our CFO, and he will run through some of the financial slides. Over to you, Manish.
Thanks, Vinod, and good afternoon to everyone. So slide number 12 is the performance focus and what is the key objective. So we continue to focus on reduced operation cost, which means fixed cost reduction and operational efficiency, and at the same time lower capital intensity, keeping in mind of CapEx and then payback. So improve CapEx and revenue ratio, expand working capital down. So you will see, despite having the increase in revenue as compared to previous year, working capital is kind of in the same level as previous year. So we are generating cash by focusing on working capital. And similarly, on growth opportunities, Vinod did talk about on the technological front, on the areas we are working. And also Vinod did touch base on the major action right now is on commodity inflation, which is impacting our financial performance, or it is a key focus area for the business at this moment. And again, ultimate objective is to optimize shareholder value by cash generation and targeting the growth of opportunity. Maybe the next slide, slide number 13, some of the customer award and recognition. So I think in quarter one we won 22 partner level supplier awards, and that I think for the full year we have a couple of awards from the customer, which is listed in the slide. On to the financial slide, slide number 15. You have heard Vinod mention in his opening comment that market for the quarter four was down, and also it has impact indirectly in the export because of the US and Europe situation due to the Russia and Ukraine war. So our sale is down from the previous year, almost 6 percentage point. Mainly it is coming out from railway and defense and export business. But at the same time, in the domestic market, we did better than the market. Our operational profit is almost 13% as against 4.6%. The last year we were having a one-off of retirement case, which has impacted last year performance. Also, our quarter is impacted almost 3% because of the NCS and MCS recovery for that current quarter. You can see the quarter ended pie chart on revenue. Revenue is down, as I already mentioned. EBITDA is up. As last year we were having a negative one-off. Otherwise, our EBITDA for the last year similar quarter was 16%. We are 3% down because of MCS and MCR recovery, which has impacted the quarter. EPS, the same story. Our earning per share is better as compared to the previous quarter. PBT better as compared to the previous quarter, and the PAT is also better. So last year similar quarter was impacted by the retirement case provision in our company, which has impacted the last year. For the full year, we have grown by 22% in the top line. Our operational EBITDA is almost 12%. Last year it was 7.4. If we would have added the unexceptional item, which is retirement case, we would be 11.3%. But as I mentioned, we have recovered only 3/4 of our MCS exposure, which will be recovering in the subsequent quarter, which has impacted almost 3 percentage points for the full year. For the top line, you can see last 3 years revenue is increasing trend. 2021 is impacted by COVID. Now this year was I won't say that it is fully full volume, but this year also we were having some impact of Russia, Ukraine indirectly, which we did mention, and also we have an impact of COVID, and also there was semiconductor issue during the start of the year. EBITDA, we are on the increasing trend. You will see in the subsequent quarter, we will be recovering the balance portion of our raw material price increases. So I think EPS is also recovering trend, and similar PBT and PAT you can see on the slide 20. On the slide 21, as I mentioned, our quarter is 3,508 million, impacted by US and European markets, reducing the export content by 2% overall of the total revenue. As I mentioned, revenue growth is better than the industry growth for the current quarter. EBITDA 459 million as against last year 174 million, and there was a negative impact of 428 million last year. So we are 12.9% as against 4.6% in previous year same quarter, and company has a net profit after tax of 191 million. Full year 22% growth, better than the industry. EBITDA is 11.6% versus 7.4%. If we have to exclude the extraordinary item incurred last year of the retirement case, EBITDA was 11.3%. As I mentioned, our financial performance was impacted because of the time lag in recovery of material prices. If we would have recovered the prices in the same year, our margin would have been improved by 3 percentage points. So till now, our 80% of customers we have a contract for the recovery, and we have recovered only 3/4 in this year. Again, company has a net profit after tax 528 million, and we had a cash of almost 1,236 million. With this financial performance update, I will hand it over to Dr. Khalid Khan for CSR activities. Over to you, Khalid Khan.
Thank you, Mr. Manish Chadha. Hello. Yeah, thank you, Manish. Coming to the CSR activities during the year, so the company spent during the year around 1.16 crore rupees. Actually, we overspent by 6 lakhs, which will be adjusted during this current year. And these are some of the glimpses. We distributed uniforms to Vidyalaya School for deaf and blind. Then we also contributed and donated to SLI Center in Bangalore. And in terms of our recognition, we got Excellence in COVID Management Award from PNGI Forum and Professional Network Group of India, Bidari. So these were some of the highlights. Our efforts were recognized through the press releases also. So the press covered the work that we did. I would like to hand it over to Mamta. Mamta, over to you.
Thank you, Khalid sir. So now can we begin the Q&A, Peter?
Yes. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to only use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Sakib Kapoor with Kapoor Co. Please go ahead.
Yeah, Namaskar, Hansab, and thank you for this opportunity. Sir,
Thank you.
I missed your some part of your opening remarks, so sorry for the repetition question also. Sir, firstly, if you could give us some color on the utilization levels, and I think so earlier 2 quarters earlier you were explaining to us the impact of the chip also mitigating in times to come. So where are we in terms of the shortage and the pile up in the demand for the four-wheelers, the passenger cars? So if you could some more understanding and what is the visibility of business going forward, sir, currently?
So, thank you, Mr. Saket. If I understood your question, let me put a perspective that when you look at the market, how it behaved, say this particular quarter, which the results we are discussing. So the passenger vehicle, they on the previous quarter basis grew by 21%, commercial vehicle 32%. So these are very good numbers on a low base. So this clearly shows that the market in these 2 categories, which was impacted by semiconductors, has definitely improved. Having said that, still our OEMs are claiming about 600,000 passenger vehicle, waiting for delivery. There's a claim that there is a booking done, but not able to deliver because of still the demand is ahead of semiconductor. So when we discuss these utilization, probably Manish will give some absolute numbers also to you. So obviously on these front, our lines were loaded nicely. Having said that, we can still absorb more on these lines if the semiconductors are made available as claimed by the OEMs. There's still a deficit about 10% if I have to put that number. Nevertheless, when you see the two-wheeler and tractor, particularly this quarter we are discussing was in two-wheeler, we were told that this was the worst quarter for a two-wheeler in last decade. That's a number indicating. And tractor, it had a prolonged, I would say, impact, coming from, if you recall, the quarter or second half of 2021, which was impacted mainly through the unseasonal rain and south and all, and then the rural economy started kicking in. And with the result that, the tractor were further, lower than the previous quarter by minus 10% actually. So accordingly, our lines utilization behaved, like that. But I'm happy to report that our position consolidated, further, in the sense that the way we are segmented into these market segments, our revenue is ahead of industry. So that's one way to look at, and by a significant good numbers. And when we paint an overall picture for last year, just to give you a perspective, our revenue, the way the market has gone, should have been up by 15%. but our revenue with respect to the last year, when you see sum total, grew by 22%. So that indicates, our positioning, which we have been mentioning before. So as it is progressing, it is becoming clearer that the business is more consolidated towards established player who have technology and they are able to establish their sustainability. So that's how probably we should look at our situation with respect to the market. With respect to the absolute utilization of our lines, maybe Manish, you could jump in and
Yeah, thanks, Vinod. So if we have to look into the capacity utilization, I would say it is 75 to 90% in the different value stream, as you mentioned, light vehicle and commercial being good in line with the market. The market is going better as compared to the previous year. So I would say their utilization may be in the range of 90%, and in the case of tractor and the two-wheeler, it may be in the range of 75 to 80%. So that's how I look into the capacity utilization in the current quarter. I don't know.
75 to 80. Manish, if you could speak just closer to the mic, you sound better for us.
So what I'm saying, in the case of tractor and bi-wheeler, the capacity utilization will be somewhere around 75 to 80. And whereas in the case of commercial and light commercial vehicle, it will be in the range of 90%.
Okay. And if we take the way forward, as depending upon the deliverables from the OEM the schedule, how are things shaping up currently, since we are already for 45 days into the new year, and also we must be having the schedules ahead from them. So how are you? What is the visibility there?
So market is doing good. If you have asked me for last 45 days and the next schedule for maybe say for another 1 month or so, the market schedules are good. We see market is consolidating and recovering. But at the same time, there is an uncertainty of China lockdown and supply chain issue. But I think this quarter we should do better than the previous quarter. I don't know whether this is your question or what, but that's
yes,
how
sir, I was just trying to get the sense of the business environment prevailing currently.
So if I may add, Mr. Saket, the passenger and commercial vehicle, are, I would say, largely dependent upon the semiconductor. So semiconductor availability has improved, but you might have seen all the OEMs, leadership going to the media, still claiming that they can produce more if the semiconductors were available. So, but on a quarter-to-quarter basis, these two lines are there's a definite improvement, but there is a significant improvement which is much more comforting for us on the tractor side, actually. So the tractors are back with the season, and the two-wheeler, again, at least, it had gone into deterioration path, is also coming back. And we are told by the two-wheeler, manufacturer that the recent incidents of some of the electric vehicle, you might have seen incident of catching fires and all. So there were a set of users, end users, who were delaying the decision because they thought that electrification is around the corner, and but actually it was not. First of all, the availability from the established player was limited, but the new players, the like of Olas and others, they did launch a few models, 20 of them, but majority of them had issues actually, and that's where probably the government jumped in and they started putting some regulatory framework around this, and they also enforced some mandatory recalls actually. So what we are told by these our OEM suppliers is that the demand in the two-wheeler is picking up back in the ICE, because users want to still see a very stable two-wheeler and safe two-wheeler actually. So for the time being, I think since you asked this question, even these two markets are back. So in summary, probably, this quarter could be, close to our best quarter. That much I can say.
Okay, sir. And on the buyback front, Khalid Saab, if you could give us some more color, what is the state of affairs currently with, I think so, Tenneco being taken over, or the thought process, and currently, what is the status of the buyback and how are things going to unfold going ahead?
Okay, first of all, can you hear me?
Yes,
it is not a buyback. It is not a buyback. It will be a tender offer to the minority shareholders, right?
Okay.
So it is dependent upon completion of the transaction for Apollo Group, and that transaction is still not completed, right? And in the meantime, acquirer is working on this transaction and on the letter of offer. We have been providing the information wherever we are asked to provide. Other than that, we don't have much visibility on that because this is driven by the acquirer, right?
Okay. So just to sum it up, the existing promoter Tenneco has been acquired by some other company, Apollo. And it is now Apollo that is seeking asking the minority shareholders to tender their shares at 272.
Right. Absolutely right.
Okay, then just a hypothetical question, sir. In the case this process goes through, then again the same thing about this lowering of promoter stake and increasing the floating stock. The same thing needs to be repeated once again for the company to comply with the listing norms. We as an organization are going to be there in the listing space, or is there some thought again a different thought process altogether with Apollo?
Okay. So we are not having any information from the acquirer so far, right? So we are presuming that it will be just a repetition of the earlier process.
Okay. It will depend how the tender process goes through and what percentage of shares are required.
Absolutely.
Okay.
If I may add, Mr. Saket, the process will be the same what happened, 3 years back. However, since you asked a very pointed question about whether it will get delisted or not, so you can imagine that that is completely with the acquirer, and there is I would say one event which will be in public domain, which is on I think 6th or 7th of June, where there is a shareholder approval will be taken. And then there will be some regulatory, clearances which Apollo has to go through in different regions. So once that is done, then this process will be kicked on.
What is the event, sir? 6th and 7th June? What will happen at that time?
That's a shareholder approval, in US.
So, Mr. Saket, there are certain prerequisites for completion of the transaction, right? There are approvals required from different regulatory authorities as well as from shareholders. So shareholder approval is to be taken in the month of June. Then there are other regulatory approvals in different jurisdictions. So that process is on. But as I said earlier, we don't have much visibility of what's happening, right? Because this is driven by the acquirer and this pertains to the acquirer.
Correct.
Okay.
Yeah, I got your point there. And lastly, sir, if we take the employee cost as a percentage of sales, what should be the number we should look? Currently for this quarter, it was 21%. Correct me there, sir. On a top line of 351 crores, we have an employee cost of 76 crores. So, do we look any rationalization at the employees' strength and at the cost? Or is this the structure like this that it will remain?
Mr. Saket, let me take this question I think you have pointed out a very valid question which we are also focusing. If you see our cost, employee cost has gone down 2% as compared to the previous year in the previous quarter. And at the same time, for full year, it has gone down by 2%. So I think we are targeting this employee cost as one of the productivity, operational productivity, and we are targeting it somewhere around 20%. Okay, so that is the first goal we are trying to achieve, and I think it is not an easy task, but I think over a period of time, whatever action we are taking, we will progressively acting on that. So you can see the 2% down as compared to the previous year and also the previous quarter. So efforts are on.
Right, sir. Okay, sir. And lastly, on the dividend part,
it's a long process because you have this is again technical people making this product, and we have to keep the people in mind, and also we have to rationalize the cost. So we are working on that. But this is one of the key areas we are focusing.
So just to add,
please.
if you see, we have inflation and other merit increase also considered. And if you see our presentation also, we are not talking in any way the number of headcounts which we are reporting. So the manpower cost saving is not by by any attrition of the manpower. Let me clarify. Or we are asking to rationalize our manpower. No, our big push is to see the opportunities in front of us, how we can capture with the existing resources actually, and that's what we are aiming at. And we hope to see a below 20% number range, as Manish said, very much possible in very near future actually. And the trend is good, and fortunately the market is also shaping up the way we had I would say planned in our market position. So that way it is going up in that direction. It is giving us an opportunity to rationalize this cost, but without I would say giving any pink slips to our people. Okay. Because we want to retain skills of people because of the opportunity in front of us.
Correct, sir. And Mr. Hans, you mentioned that due to this inflationary trend, 3% of our margins have been absorbed because the pass on has not happened currently. So as you move forward, there would be an incremental increase in the margin if there is no further increase in the raw material trend. So there would be an increase of 3% on the margin front. Is a correct understanding, sir?
Yeah, that's a fair understanding. Manish can throw better light. So if you talk about this quarter, for example, we have seen a stability in the prices. In fact, a little bit softening of some of our major, I would say, input like aluminum and copper. Although silicon and nickel continue to remain high, but on these two commodities we see a softening. But during this time, we will also be getting a price increase which are applicable, say, from new financial year 1st of April with our customers. So I think it's a fair expectation to see a better number. If you talk about near future where the commodities are operating at lower than the previous quarter, but we will enjoy prices of earlier quarters actually, where the way we are contracted with customers. So as Manish said, that we have a lag in the recovery. So this lag gap will somewhat reduce. I'm not sure, looking forward after 6 months when China comes back, how will it impact the commodities again? So I think it's a kind of a cycle where in the existing short term, if the commodities are soft, and from the way we are contracted from a backlog, we get a price increase. So definitely we can expect a better quarter wherever the commodities are going down. But if the commodities again ramp up more than the ramp up of the price, we'll have this phenomenon. I think we explained last quarter, analyst conference calls also. So fortunately, as you said, these particular 45 days and next, whatever we can say, the way we have bought or contracted our material, it's fair expectation to expect a better margin. Maybe Manish, you want to add?
No, thanks. So it's actually depend on the raw material prices from the previous quarter. And as I mentioned, we have a time lag to recover. If prices go down, then we will have a double benefit of time lag recovery and also raw material prices. And definitely volume plays a major role on the contribution level. So I think these are the two factors.
Okay. Sir, at the annual, when the annual numbers were finalized, on the dividend part, we were informed earlier that the board would be calibrating ways to reward its shareholders, whether minority or majority. So what's the thought process currently? And now with the new acquirer, are things again on the back burner in terms of cash payout to your investors?
So Mr. Saket, let me take. So even in the last call, we did mention there is uncertainty around chips. There is uncertainty about COVID, but at the same time, we are willing to calibrate on the dividend thing. So as you mentioned, still we are talking about the China's Russia-Ukraine and all, and there is an uncertainty to the business because of all those stuff, and also there is open offering process. So at this moment, I think once we are over maybe another quarter or so, we will give a thought again on this whole process. So at this moment, there is nothing on the dividend per se. Looking into the market situation as well as uncertainty due to the COVID and also the China supply.
I think once this open offer is over, then it will be good time to consider, and there should be. I think things should settle in fine actually.
Right, sir. And sir, on the remuneration paid to the KMP, are they linked to the variable income also? If there is a higher profit, the payout to the KMPs improve, or are they on a fixed basis? Do you have any percentage in the net profit also?
No, I think
No.
There is nothing on to the profitability of FMG. Nothing linked to that.
Correct, sir. And sir, for the hydrogen part of the story, sir, I missed. It was on a very low voice. So Mr. Hans was explaining something on it. We were working with some odd 8 to 10 OEM players. So what is the thought behind it? And currently, what kind of R&D spend have we done on the hydrogen part? Where are we in this story, sir?
So you can, Mr. Saket, you can imagine that this is quite a significant development and a lot of interest from different regions. When I said about 10, I never mentioned about only India actually. I said we are working total about these odd platform where we are in close coordination with our customer, and the development work and the testing work has already started. Okay, so that is what I mentioned. And among those 10, there are one or two from India also. We are a front runner, and we are also in discussion with the other players as well actually. So it will be unfair for me to share, because we have signed a confidentiality document with the ROEMs actually, and but I'm happy to report you that we are the front runner in hydrogen development actually. And we are also member of, the European Council, where these developments are taken care of, and we are participating. Our views are taken by the government bodies, and so we are very much, I would say, part of those consultative committees there. And these committees are using our experience and knowledge to formulate, the hydrogen ecosystem.
But we are in the piston, ring, and valve segment. Is this circulating in this vicinity, or it is a total different landscape altogether?
So let me qualify this. Hydrogen will have our components. Okay.
Our components would be there. Yeah.
Yeah. Unlike a battery electric vehicle, pure battery electric vehicle, which will not have our components, hydrogen will have our component, and you can imagine with significant value add.
Okay, and the same profile which we currently have our facility. It is not to be anything exclusively that we have to develop separately. It is the one which we already have.
So the kind of development, the way it will happen, it is an iterative process. So you can imagine that we will have to develop few other capabilities, few equipments, and the controlling environment around this actually. So I have to say that it is not that the machines where aluminum piston is made, hydrogen will be made like that. The architecture will remain probably the same, but it will call for different alloys, different machining. But you can imagine that it will not be completely differentiated setup actually. Okay, but it will have its own add-ons to move towards hydrogen.
Right. And on the capital working
I described that we moved from aluminum to steel, and then we are changing hydrogen. So let's see how this development progresses. You can imagine that the capex globally is not unlimited. So we'll try to make a formulation which is from a capex perspective not completely off the range.
When can we hear on this front, sir? You were telling something I just missed.
So I think it will depend upon how the OEMs are able to put that ecosystem in the vehicle, and we do that. So our job is that we are trying to address the powertrain part of it, the combustion part of it actually. But you can imagine this whole hydrogen-based vehicle will require a larger ecosystem.
But the thought is there. Is it from the Apollo group itself, or from the existing management who are professionally running currently the thought process of this hydrogen theme?
So if you see one of the slides I showed was these are the drivers which are driven by the regulatory side of it actually, and this regulatory side is pushing us to go towards the hydrogen. Which is, from an environment point of view, a clean fuel, as well as, the capabilities are much enhanced. Okay, so the drive point is that. So Apollo, I would say is very new in the whole process. However, Apollo has the same view what Tenneco has on the market side of it actually. So Apollo also feel that there is electrification is still far off, and Tenneco has inbuilt, I would say, capabilities and opportunity to really capitalize on this actually, and probably that's the reason Apollo would be interested in Tenneco.
Thank you for the elaborate answer.
Yeah.
All the best and come in the
Yeah. Thank you.
Thank you. Our next question is from the line of Vinay Jain with Siddh Capital. Please go ahead.
Thank you for the opportunity, sir. So I have a couple of questions. How do we see the export shape up in the near future, and what are our aspirations there, sir?
So if I may add, and Manish can give some numbers behind to qualify your answer. So the way we are doing our expansion and the way we are working with customers, so export had a very clear opportunity for us, and that's why we are putting a capex around that. And there are several I would say global projects which we are working on. So we are moving very nicely in that direction. At the moment, I have to say that we are not able to move the needle in this quarter, or maybe in the current quarter as well. We are talking because of the situation we are in particularly European region, and some of the American market is impacted because of the geopolitical situation actually. So, but our plan on the capex to facilitate on those directions are very much, we are not stopping that, and we are continuing with that. We are assuming that these geopolitical situation would be, I would say, resolved, and I don't think it's going to remain forever. And we don't want to hold our projects for those actually, because those projects will kickstart, but the ramp up will be lower than what we had imagined before. But who knows, if these issues are resolved and we are quick on the speed. But I will leave it to Manish to give you some numbers on the capex and some idea on where we are heading, how we are capturing this actually.
Okay. So no, thanks. So if you see our growth over previous year in export is almost 17 to 20%, and that's true. Even last quarter was impacted because of the Russia-Ukraine and US and European market down. So otherwise, export, there is a clear focus to increase in double digit, and we can see that should go for the next year also. But at the same time, as mentioned, we are also looking into the global customer. We are shifting the machines from our European plant to India and then exporting from here. This is mainly some kind of a team export. The global customer base is here, and we will be shifting. We will be transferring the material from here to those global customers. So we have a plan, and we are investing in those new businesses, and revenue for those new business, maybe domestic and deemed export, is in the range of double-digit growth over next year.
So can you please elaborate on the capex taken in the financial year 22?
So capex will be in the same range. I cannot mention the number, but at the same time, you can see last year we did almost 78 crore, and we are investing on the capex the way we do in the normal way. So there are plans to invest in that range.
So can you elaborate where have we put the money, and is it on which plants and all?
So money we are putting in, I believe, all the plants. So maybe nature of the investment, maybe 50% investment in the new business category. That's what we were discussing, and the rest 50% in the range of improvement and then repair and maintenance like that. So 50% of our capex is for the new business, which we are talking about.
So how much is the maintenance capex in terms of numbers?
So for example, as I mentioned, we will be spending in the same range of the last year capex or previous year capex. So 10% is repair and maintenance, and balance is the productivity improvement. So 50% is for new business, and balance is split between the process improvement, repair and maintenance.
So when you say a new business, does that mean we are going to come up with new products, or is it only the same business or different clients?
Maybe product is the same. Maybe the new customer which we are talking about, the global customer, which are looking India as a source from the European market. Okay?
And when can we be we can have such businesses coming through?
So this business, we have invested some amount last year, and some portion of that recovery, the business will come this year also.
Okay. And so what is the capex going ahead for FY23?
As I mentioned, the capex amount will be around the last year capex and slightly more.
Okay. Thank you very much.
So we are not shying in investing. That's what the message I'm trying to do. We are making investments.
Okay. Thank you very much.
Thank you. Our next question is from the line of Rajakumar V, an individual investor. Please go ahead.
Yeah. Good afternoon, sir. Thanks for the opportunity. Just a couple of questions. The first one is on the recent the efforts taken by the government to reduce the steel prices. Just want to know what would be the benefit the company would get in this quarter and in the subsequent quarters.
Didn't you get your question? Recent announcement of government on which subject?
On the steel prices.
Okay. So if you see, we are using steel, I would say, into a category called pin. So we make piston, ring, pin, and seats and guides. So if you talk about particularly in steel, there's a commodity pin which is using this steel. So we are also kind of happy with the government making those initiatives. So the steel prices should soften off. But as I said that in pin it is used, I would say 100% steel. However, in other form, into our powder, we are using some kind of a steel iron powder, some alloys powder and all. So our consumption by and large is on the aluminum and I would say copper, followed by steel. That is the kind of I would say spend we have in that order. But we are happy to have the steel prices getting softened up, and it will help on the affordability part of the vehicle, which will eventually drive the demand up actually. So if you see the recent announcement which happened last week on the fuel prices particularly, and some of the two-wheeler manufacturer gave their comments that the two-wheeler particularly the last quarter, as I said, that was the worst performing since last decade actually. So they are pretty pleased with this because affordability was also one of the reasons besides this electrification confusion, which was putting the demand under pressure actually. So the two-wheeler had become expensive also to buy because of the regulatory I would say more requirements on not only the Bharat 6 but also on some brakes and also on the vehicle part. So the two-wheeler had become really expensive from whatever they were in the BS4 type. And besides that, with the all the two-wheeler running on gasoline, and the gasoline prices were north of 100 rupees plus actually. So that had put a lot of pressure on affordability and therefore demand. Now with this and the steel coming low, more than affecting our product, it will affect the vehicle, and we are very happy with that actually. If the vehicles are sold more, our business is better. So we can expect a better demand as communicated by most of the OEMs post these recent announcement of government, if that was your question.
Yeah, thanks for the elaborate answer. So the next question is on the impending takeover of Tenneco by Apollo. I just wonder whether Apollo has any automotive interest in India. And second thing, after if the acquisition goes through, will there be any change in management in the India unit of Federal-Mogul?
Khalid can answer.
Yeah. So Apollo is a global investor, right? So they don't engage in the day-to-day management of companies. And due to this transaction, there is no change in the management so far. We don't anticipate any changes in the management globally. So that answers.
Yeah, and do they have any other interests apart from Federal-Mogul in India?
In India, in the auto sector, I'm not aware at least.
So Apollo, if you go to their site, they're very, I would say, transparent, and they have declared their portfolio very nicely. So to our understanding, it is pretty large, $500 billion, widely distributed into a very highly reputed companies. So they do debt financing, they do this capital, I would say equity. So of the recent, I would say media news, you would have seen. So Apollo is very much involved into the debt financing part in India. So if you pick up the media news during last 4 or 5 weeks, particularly, which we started looking at from that perspective. So there were 3 major, I would say, debt financing done by Apollo, and 3 of the big names in India. So I would say they know India pretty well, but we don't know whether in the equity side, besides us, if they are invested or not, at least not appearing on their portfolio.
Okay, sir. Thanks for the elaborate answer. All the best.
Thank you. Ladies and gentlemen, that was the last question for the day. On behalf of Perfect Relation, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you all.
Thank you everyone.